Order, order. Welcome to the Treasury Select Committee on Wednesday, the 28th of January 2026. We're delighted today to have a one-off session on mutuals. This is partly because the government has a pledge to double the size of the mutual sector, a mutual cooperative sector across government, and we have obviously a role in looking at how that is delivering in the financial services sector. So we're really pleased to welcome the Chief Executive of the Building Societies Association, Sarah Harrison, and we're the Chief Executive of the Association of British Credit Unions, Matt Bland. And I think it might just be helpful, so for anyone who perhaps is not tuned into the difference between a building society, Ms Harrison, and a bank, what it is that makes a building society a mutual, and what you think is special about that. If you could just briefly explain, and I'll come to you, Mr Bland.
Thank you, and Chair, thank you very much for the invitation to be here. And for those that don't know me, I'm very new in role. Pleasure to be leading the Building Society Association. This is week 9, but it's a privilege to be giving evidence to this committee today because I know of your both interest and deep expertise, and I look forward hopefully to working with you on many occasions in the future. I think the simple explanation is that building societies are owned by their members, by their customers. There's no external shareholder interests in building societies, and as such, building societies can both focus specifically on their customers, can ensure that the services they provide, principally mortgage lending and savings, are very focused on those customers, that the returns that are made are really put in service of those customers in terms of improved rates or better service. And of course, the other feature I would say, particularly about building societies, is that they have a very strong presence across the United Kingdom. We have 1,300 branches, which is about 35% of the share now of branches, and we've retained very much our presence deep in communities. And that's not just the branch on the high street, but the strong commitment to community support in many shapes and forms. And I look forward to the opportunity perhaps talking about that later today.
Thank you, Ms Harrison. Now, Mr Bland, do you want to explain what a credit union is for those who are uninitiated?
Of course, and may I echo Sarah's sentiments at the beginning as well, that we really do welcome the opportunity to speak to you today and to talk about the role credit unions play. So a credit union, much like a building society in that respect, is owned by its customers. We're cooperatives, so it's owned on a one-member, one-vote basis. So we're democratic financial institutions, and we're deposit takers, so we take savings from our members and use those funds to lend to members. And typically credit unions are very focused on financial inclusion, so it's about addressing gaps in the market, providing affordable credit, and creating a pathway for people to transition from debt into savings and to build financial resilience. Typically, credit unions will focus on communities or on workplaces and employment sectors. And we have, in the UK, around 350 credit unions active today. There's a strong concentration in Northern Ireland, and in the rest of Great Britain it's not quite the same. I'm happy to get into the reasons for that.
Thank you, and we'll get on to some more details and questions. Now, introductions are over. I just need to ask for declarations of interest from the committee. Mr Dixon?
I am a member of a credit union in South London.
I have a family member who works for a large building society.
Jan?
No, thank you.
I'm a member of the Cooperative Party.
I'm a Labour and Cooperative MP and a member of the Co-op Party.
I have nothing.
Okay.
Chair, sorry, I should add I'm also a member of the Co-op Party.
Member of the Co-op Party.
As am I.
Thank you. Okay, so thank you very much for that explanation. I just think it sets the context. Now, obviously, one of the reasons we're doing this session is because the government made a commitment in its manifesto to double the size of the cooperative and mutuals sector. It wasn't specific about how much that would be in the financial sector or cross-government as a whole. And I just wondered if you think it's a target that's achievable. And secondary to that, to Ms Harrison in particular, does that mean bigger nationwides or lots of smaller building societies? I mean, in your view, how do you think this could play out, or how would you like it to play out?
I think that's a great question. I think obviously the Dublin commitment is really powerful. I mean, this government's signalling its very strong commitment to the growth of mutuals and cooperatives, and of course, in my context, building societies and credit unions. We have credit unions within our membership. And I think the way that we're approaching that as the Building Society Association with our members is really to think about, what are the conditions that really need to change in order to see that growth. And as a result, we actually published a sector report and a growth plan, actually the back end of last year, which signalling the need to see changes to legislation, changes to capital regulation and routes to access to capital, and actually just a more powerful and consistent seat for building societies and credit unions at the table with government alongside shareholder-based banks, particularly when it comes to financial inclusion, financial competitiveness and growth. It's not... There are all sorts of different ways that you could otherwise calculate what it would mean to see a doubling of the sector. And probably each of them have their strengths but also have their weaknesses. You could pin it on GVA, and you've seen actually in the building society sector, if you look back over history over the last decade, quite a substantial doubling already of the asset base of the sector. Whether it's credible and achievable to see a doubling again over the next 10 years remains to be seen. It certainly ought to be an ambition. But that would risk missing the point, because in many respects this is not just about numbers of members, both customers or numbers of building societies, or indeed numbers of branches. It's about the impact on customers in terms of access to lending, access to competitive rates for savings, and actually community benefit, which is deep and consistent across the building society sector. So I think for us, because it's the government that set that commitment, the powers that the government have to act are actually in the space of legislation and regulation. Those are the things that have governed our approach to what it is that's needed to see those conditions for growth in the future.
Okay, we're going to go into some of the detail about potential legislation a little later, but Mr. Bland, from your point of view, do you think credit unions can double in size, or do you think that you're the bit that won't increase and other bits of the financial mutual sector will?
Well, I very much think that we can. So if we look back in recent history, over a decade period between 2002 and 2012, credit unions in Great Britain doubled their membership successfully. And at that time, we were supported by a financial inclusion strategy, which, had a concerted programme of investment and reform focused on growth of the sector. I think, we have similar conditions now, and it's, there's definitely reason to believe that we could do that again. Ms Harrison referred to a growth plan that has been published for building societies. We actually just later on today are publishing our own credit union sector growth plan, which has been agreed across the representative bodies that represent credit unions. There are a number of us. And that's all under the auspices of the Mutuals and Cooperative Sector Business Council, which both the BSA and ABCL are members of. So we're trying to answer that question about how you would do it. And there's a whole range of things. Some of that's about the credit union sector itself and things that we need to do to enhance how we work. But there are regulatory and legislative things too. And of course, the financial inclusion strategy that was published in November is a key part of that too, because there's a commitment there from Treasury via Fair for All Finance to invest £30 million in transformation of credit unions in England, reforms to the common bond, and so on. I know we'll have a chance to get into some of the details of those things. There's also a commitment in the Mutuals Landscape Report from FCA and PRA published just in December to review regulation for credit unions. So, there are opportunities for us to address some of the issues we think there are within the framework that could unlock some of that growth, as well as things we need to do as a sector.
Further to that manifesto commitment, the Chancellor announced at the Mansion House in 2024 that she'd set up a mutual and cooperative business council. I'm assuming you're both involved in that?
Yes.
How often has it met?
Yes, and I'm looking forward to attending my first
Of course, yes,
which I haven't yet had the opportunity to, but very much looking forward to it. Matt, I think it's met twice.
So I think maybe 3 times. So I'm also relatively new in this job, 6 months. So I joined in June, although I've a long career in credit unions and I worked for ABCL previously. So I've attended 2 meetings. I think there was one before that, and there's one coming
up in a few weeks. So what's it like? Just tell us who's around the table.
So it's all of the largest businesses in the sector, so Nationwide, Building Society, John Lewis, Co-op Group, and others. Royal London, the Financial Mutual, and so on, as well as the primary trade associations representing different parts of the sector. And
what officials are there from which departments?
The Department for Business and Trade and Treasury attend, and we've had attendance from ministers. So, there's good engagement and support from government with that process.
Is there good understanding? I say this because many years ago I was a minister and I looked to try and mutualise and know what part of government, and it was not a deep understanding in Whitehall about the cooperative and mutual sector. Do you think that is changing, and is it changing fast enough?
I think it's beginning to
Mr.
change.
Van, then Ms. Harrison. Yeah.
Well, yes, I mean, absolutely. My opportunity obviously to discover this for sure, but I think, obviously things like the Mutuals and Cooperatives Business Council create a forum on a continuous basis to be able to bring ministers and officials and members of the sector together, partly obviously to achieve outcomes, not least those associated with doubling, the doubling commitment, but actually more importantly also around education. And the reason why I emphasised in the BSA's sector growth plan that third objective of just having a seat at the table alongside shareholder interests is because I think there needs to be a deeper understanding of the mutual model. I think it plays a really important part in the sort of diversity and competitiveness, not just of our financial services sector, which happens to be the subject today, but actually more widely. And I think I'm very keen to do what I can, not just with DBT and HMT obviously, but actually other departments to really build that understanding, because I think there's an appetite, but I think there's more that we can do.
Okay, Mr. Bland?
Yeah, I would agree with that. I mean, I think that the example I already mentioned, the Mutuals Landscape Report from the FCA and PRA, I think we've seen a real evidence with that process, which took a year or so, commissioned by Treasury, within both institutions, Bank of England and FCA, of a real deepening of their understanding of the role of mutuals and cooperatives and the different challenges that we face as businesses and the important role we play in markets and so on. And so I think there's an opportunity to do something similar across government departments and Whitehall too. The focus at the moment does seem to be on the two departments we've mentioned, and I think potentially there are opportunities to do more in, for instance, net zero and the green transition. There's a role for financing, there's a role for cooperative business models, likewise in education and elsewhere. And so that would be, I think, a positive contribution if we could get there of this commitment, if we could bring, a deeper understanding across Whitehall of the role of co-ops and mutuals.
Thank you. Mr. Dean.
Thank you, Chair. Ms. Harrison, in your earlier answer, you sort of speculated about what the doubling the size of the sector might mean. I guess we're 18 months into this government. I kind of would have expected maybe to have defined that at least by now, so we know what we're working towards. I also know that in the Treasury's financial services growth and competitive strategy, there's very little attention paid to the growth of the mutual sector. I think one paragraph was dedicated to that. Isn't the truth that the government haven't really focused on this commitment at all so far? And are you looking for them to engage with you more thoroughly?
So the answer to the last part of your question must be yes, and that's not to imply there isn't engagement, but the deeper and more extensive that engagement with government and the regulators, of course. I think we've seen evidence definitely of that in the back end of last year, but more of that engagement is really important. I mean, on the competitiveness and growth strategy, I would note exactly the same as you have. I think it was page 55 and about half a dozen lines. However, I think that belies actually what the mutuals, financial mutuals, can really contribute to many of the themes of that competitiveness strategy. So one is really around diversity in all of its senses, because diversity is a strong contributor to competition, and diversity is something definitely that the building society sector brings. And alongside that comes innovation. If you look at some of the savings situations in the UK, had it not been for building societies and credit unions, there wouldn't be the more competitive savings, interest on savings that we have today. Similarly, if it were not for building societies, you would not have the strength of competition that we have now in our mortgage market and the ability to be able to access. There's, of course, much further we have to go. So I think that's a very good example of where the mutual sector, financial mutual sector, can really contribute to competitiveness. Another, if I may say, in the strategy relates to the concept of regional clustering and building strength and capability both in skills and businesses across the regions. Building societies are absolutely deep-rooted in communities. None of our members are headquartered in London, and therefore they play a very valuable part, not just in services to customers, but as partners in their communities and in our regions. So there are very good examples of that contribution, but we need to see that more powerfully expressed and recognised.
Thank you. And Mr. Bland, obviously there has been quite a lot of talk about financial inclusion strategy being released recently. Yeah. And you mentioned that that's kind of a core concern for credit unions. Mm-hmm. Do you feel that you've been properly included in that financial inclusion strategy development process? Do you feel that similarly that you want the government to pay more attention to credit unions, or do you feel like you've been engaged with properly so far?
I mean, you know, as we said, I think there are opportunities to go further with that engagement, but, you know, equally the commitments in the financial inclusion strategy are very significant for us, alongside the Mutuals Landscape report I mentioned also on regulation. So, you know, we could always go further, and I wouldn't say otherwise, but we're pretty pleased with the engagement we've had with the on the common bond, for example. There's a commitment to review and reform the common bond, which we understand, although the detail hasn't yet been published, will be very closely aligned with what the sector would like to see, and the investment in the sector through the transformation fund that I've mentioned. Our work with Fair for All Finance, who are the body responsible for delivering that, suggests that they're likely to be closely aligned with the growth plan that we're publishing today, and the kinds of things we think the sector needs to do to move forward and grow. But equally, of course, there are opportunities to go further with government engagement, and we'd like to build on the success that we've had so far.
Thank you. Ms Harrison, you also mentioned in one of your early answers about the role of legislation. When we had FCA Chief Executive Nikhil Rathi, and he said that he doesn't feel like legislation has been prioritised. He said some bits have been waiting 17 years to be reviewed, and he said in particular there's stuff relating to the Building Societies Amendment Act passed in May 2024 that are still yet to be processed. Are those things priorities for you, or is there other things you want to address first? I mean, what legislatively do you want to see happen this year?
Yes, and I would agree with the Chief Executive of the FCA in that respect. I think there's a couple of things I'd say there. I think he was referencing a couple of statutory instruments which are still waiting for implementation, and obviously it's really important that we get on with that. And it's worth just referencing one of those, which in fact is to remove the requirement of building societies to apply a corporate seal to corporate documents and decisions. Now, that is extraordinary. That disappeared from the Companies Act 20 years ago. So one obvious first step would be simply to align any changes with companies' law legislation to be applied directly at the same time and contemporaneously with building societies legislation. That is not a difficult thing to do, but it would be an obvious first step. More specifically, though, if I dig deeper into the building societies legislation, there are limits that are placed on lending and on credit and other things. And what they do is they just naturally cap growth.
Yeah, and we'll come to some of the detail of that.
Particularly in relation to lending to business customers. So there are a number of things. And if I have the opportunity when it comes to it later, I'd like very much to talk about the absence of legislation in some cases as well.
Thank you, Chair.
Thank you very much. John Glenn and then John Grady, MP.
Yes, Mr Bland, during our previous interactions when I was Economic Secretary 2018 to 22, we did a number of things. We doubled the common bond from 2 to 3 million. We allowed the car insurance and hire purchase to be products that credit unions could offer. And we also did the prize-linked savings schemes. Are there specific things of that ilk that over the last 18 months you've had conversations with the government about doing? Because it'd be good to try and understand what practically you're going to aim to achieve during the rest of this time.
Yes, absolutely. So on the common bond, so the 2 million to 3 million change, we want to take that further to 10 million. And the reason for that is the 3 million cap is creating some distortions. So we have an example, for instance, where two credit unions combined, one serving Nottinghamshire and Lincolnshire, another in Leicestershire, and the combined coverage exceeded 3 million. So they had to take services to Lincolnshire out of their common bond, which seems like a perverse outcome from a sensible piece of consolidation for two credit unions to enhance what they can do for both areas. So a 10 million cap would allow those kinds of consolidations, as well as an area like Greater London or a region like the West Midlands, Greater Manchester, to also be covered comfortably by a single credit union. And fundamentally, one of the challenges for our sector is about institutional scale. Lots of the credit unions are subscale and need to get to a critical mass in order to have the economies of scale to invest in things like digital technology and meet modern consumers' expectations. There are concrete things we'd like to do in respect of that. You mentioned also the product innovation, and we were very glad to see those changes made in 23. The truth is the credit unions haven't made use of those powers yet, And the missing piece, I think, partly is about investment. So we're excited to see the investment that's committed to from Fair for All Finance to enable us to do some of those things. And one of the mechanisms we expect to be critical with that is collaborative business models or credit union service organisations. And the PRA have been consulting on rules to help those form just recently. So, there are things we want to do to build on the good work that we did with you back in the day. On Prize Saver, I'd mentioned Help to Save. I know that again was something that you supported at that time. But we do think that if credit unions could play a role in delivery of something like Help to Save, institutions, as Ms Harrison has said, that are much closer to communities, they can reach the people that product was intended to reach. Whereas NS&I, a national provider, very remote from communities, hasn't had that ability to engage with the people we're trying to reach with that product.
Thank you. A brief one from Mr. Grady.
Just to follow up, Mrs Harrison, on your point about company seals, is your point fundamentally, or one of the key points you're making, that whereas the law relating to companies was thoroughly modernised in the mid-2000s and then gets modernised after that, the law for building societies, credit unions, industrial and provident societies has been left behind. So you've got this inherent friction in the fact that you're not benefiting from the same sorts of things that ease things along. And if you could make it quick, because otherwise we'll get behind and we don't want to do that. Thank you.
Quick answer is yes. Worth just noting, the Building Societies Act, of course there have been some amendments, is 40 years old.
Yeah.
The credit unions legislation is 50 years old.
Yeah.
It's time to modernise.
Thank you. Thank you, Dame Meg.
Ewan Yang MP.
Thank you very much, Chair. Coming on to the regulators, Mr Bland, you already mentioned the Mutuals Landscape Report and how that's deepened the understanding of regulators and the bank on what the situation facing your sector. Was there anything missing from that report that you would have liked to see in it?
I don't think so in terms of the purview of the report itself. So the PRA-FCA, I think they've done some great work. We were very encouraged by the commitments made in the report. The commitment in particular to review credit union regulation is an opportunity for us to advance some of the things we think regulation holds us back with currently. There was, however, a reference to legislation for credit unions, which only went as far as suggesting Treasury may consider a review of credit union legislation. And whilst we appreciate the things that are in train on Common Bond, I've mentioned already, so we do appreciate that. There are areas where we think our legislation could be improved around our role, for instance, in supporting businesses, for example. And so, it'd be nice to see that suggestion in the report taken forward by Treasury, because it'd be a convenient time to do so in line with a review of regulation. Yeah,
but that's on the side of Treasury rather than the regulators' understanding.
Exactly.
Yeah. And Ms Harrison, was there anything from your perspective that you would like to see in the report?
So I think, as with Mr Bland, the Mutuals Landscape Report was very positive to see. And I think probably a couple of things I'd say. One is what was missing might be the sort of and what next. What is the plan that then puts things into action, and similarly, what are the measures by which we might want to assess progress? Deeper in the regulatory space, though, are unquestionably significant issues around capital regulation. And I'm going to be delighted to talk about that in response to your question, or indeed later on in the evidence session.
We'll come on to that next.
Thank
you. Have you been in conversations with the FCA or the PRA about the what next part of the picture?
Actually, it's very timely because we're in the process of engaging. I've had very first up introductory conversations, very keen to work with both regulators and now engaging on exactly that, on what next and what are going to be the projects. For example, there's a new mutuals development unit that's being established alongside the scale-up unit. I think that's a really positive step. Yeah. So what's going to be the work programme of that unit? What are the projects? How is it going to work with the sector? These are the things that we want to now see.
Yeah. Is this at the very early stages of setting out a timescale for those projects, or whereabouts are you in that project establishment?
Well, we're at the stage of really genuinely coming back together with the regulator to understand more of their plans, and obviously to have the opportunity, hopefully, to contribute our ideas as well.
Yeah, thank you. And Mr Bland, what about your conversations with the regulators on what next?
It was similar to Ms Harrison in that respect. The report in fairness to the regulators, was only published at the beginning of December. So we need to develop that work plan. But the commitment made and even the optics of them coming to Rochdale to publish it, does indicate, I think, a genuine desire to follow through. And there's some real expertise, particularly in the FCA, with the mutuals unit that is responsible for registering cooperative and mutual societies. So I think there's a big opportunity there. It's early days, but we're optimistic.
We'll come on to the capital requirements a bit later, but aside from that area, Mr. Bland, is there anything else that you'd like to see in their action plan?
In terms of regulation?
In terms of regulators, yeah.
So there's one area in particular that we see. So members of the committee may be familiar with the fact that credit unions in the UK, and GB in particular, if we exclude Northern Ireland, as I mentioned, are disproportionately large, are smaller than they are internationally. So we often look to other parts of the world for inspiration of models that work. And one of those is about central financing. So credit unions around the world quite often would have a central institution that helps manage liquidity across the sector. You could have lending between credit unions. It could provide a gateway to access to the Bank of England facilities that large deposit takers, banks and building societies enjoy. And we think there are things that could be done to facilitate that, like relaxing the rules around lending between credit unions. The other big area is capital, but I understand we'll come on to that, so I'll leave it there for now.
Do you see that kind of central unit as a government or a kind of independent run unit, or more as another credit union that then takes on powers to clear accounts across credit unions?
I think it could take a number of forms. I think the initial step that we envisage would be to facilitate this sharing of liquidity around the sector. We have some credit unions that are in need of additional liquidity to continue to lend into their communities. Others that have excess balances sitting on deposit that could be put to work for the greater good of the sector. It's that kind of thing that we have in mind as an initial step. Where that might develop into, it could go in a number of ways.
Thank you.
Thank you very much, Ms. Yang. I mean, you've both repeatedly talked about legislation delayed or not happening. Has anyone ever told you why legislation in this sector has not been prioritised?
Obviously parliamentary time is often
so that's an excuse.
I
suppose 9 weeks in, you perhaps haven't had those direct conversations.
I mean, these are conversations to be followed up on.
Yeah. There's no concrete reason. I mean, so parliamentary time. Anything else that's been put forward as a reason?
They don't really need it.
Because we was just under a year ago, we were in Darlington to discuss the work of the Treasury, and our former colleague on the committee, Rachel Blake MP for Cities of London and Westminster, a Labour Co-op MP, I should stress, and she asked the question about what are you doing about the mutual sector. Tumbleweed across the room, as was a very long pause by the Permanent Secretary before he could answer that. So although there's been some things that have happened since, the Mansion House speech was before that. That told us that there wasn't an awful lot going on in the Treasury. Is that a fair comment?
Well, I think the abiding kind of business model that officials and others have in mind whenever they're thinking about their policy objectives is the privately owned PLC model. That's the truth, and to the point that Ms. Harrison made earlier, what we want to achieve through this commitment is to change that by embedding and deepening that cultural understanding of the mutual option. Because I think the truth is it feels like an afterthought often, but I don't think that's necessarily a conscious decision.
And you need this legislation from what you both said, you need legislation to help you progress. Mr. Murphy will pick up some of this, but you need something.
Yes, because as you know, in the building society sector, we've had some very significant acquisitions, which is fantastic because for the first time, we've now got business customers who are going to be able to be served by customer-owned banks. But there are hardwired into the legislation some caps and issues there that might stand in the way of that. So yes, we have. If we're in the business of growth, and this government is in this sector, if my engagement, very early engagement, I'm confident of that. But the questions are probably best put directly to officials.
Well, partly why I'm asking is because we have a reprise of our session with the Permanent Secretary in a month or so, less than a month. And the Mutual and Cooperative Business Council, just to go back to that for a moment, do you discuss legislation at that meeting?
Yes, we have done, and in specific, we're looking at specific themes. So they may be sectoral, with the council's published a report on credit unions, or they may be to do with a particular...
So just to be clear, just about the process, so you've only, obviously, it's difficult for both of you, you've not been in your job that long, but Mr Bland will focus on you because you've been to 2 meetings. So if legislation prospect is raised, what's coming back from officials and ministers at that moment? Are they saying we'll take it away and we'll think about it? Are they saying no way, or we're just waiting for part meeting? What's the feeling?
Well, there are a number of concrete things happening. So there's 2 law commission reviews, one into cooperative law and one into friendly societies. So, that's often referred to. So we need to see those things report, and then hopefully the government will commit to doing taking the recommendations forward.
The parliamentary time, the law commission, that's 2 reasons that there's a delay. Anything else they're saying?
I wouldn't say they've given lots of reasons.
Well, just as a recovering lawyer, can I ask this question? The Companies Act runs to many, many thousands of pages. And, as you say, a lot of this legislation is 40 years old or more. So there's quite simply the hard work in going through each provision and saying, do we need to update it? Or it's just hard work. In your opinion, does the civil service and the Treasury have the right experts in it to be able to, or DBT or wherever, to undertake this work and just get on with it? Because a lot of this is, frankly, quite mechanistic work, getting rid of a provision for company seals and meetings and things like that.
Mr Bland.
If I may, I think that we have the list of things we'd like to see changed in our legislation. We don't necessarily expect the officials to do that work for us. We can provide the list of things, the law commission processes we've mentioned already. So it's about taking that forward. It's interesting, in preparation for this, we were chatting to a colleague who's long history in this world, longer than both of us, who mentioned a power that is on the statute books and has been since the early 2000s to allow for cooperative and mutual legislation to be updated by secondary instrument on points like the one Ms Harrison raises, administrative barriers and blockers, but it never seems to be used. So that there are things out in the legislation we could just use to do some of this by secondary legislation. So to the point, maybe there is a gap in expertise on that point.
Or perhaps you'd like to send the committee, if you may, Mr Bland, a shopping list and a reference to that particular power. And Ms Harrison, how about you? Again, sorry to hurry you along.
Well, again, first up, I would be delighted to write to the committee and set out some of the things that we would want to see in terms of legislation. First up is just the implementation of those 2 statutory instruments passed in 2024. My engagement with the Treasury, gives me positive thinking and a sense that we will see progress on those, and that's really important.
I think before I move on to Mr Murphy, just to be clear, so do you think there's any issue about commercial competition that's hampering any changes? I just want to either rule these things in or out. Is it just process, you're thinking? Is commercial competitiveness an issue that the Treasury is worried about?
Not my experience, no.
Okay.
Not my experience
That's
so
fine.
far.
And do they think, are they worried about how a level playing field, that that there might be challenges of having 2 different sectors, boosting your sector compared with what's happening with other financial institutions? Is there anything you're getting there?
No, I wouldn't say so. I mean, the examples we've given demonstrate that this is about a level playing field for us with companies. So I think that would be a fairly weak excuse to give. Okay. I do think it's about capacity, and within Treasury it's a relatively small team that's responsible for our stuff relative to the wider remit. And there are decisions operationally about how that's done that maybe could be looked at.
Well, we're getting quite strong messages. A lot of it's procedural and knowledge, and that's very helpful indeed, and certainly follows on from what we'll give the Permanent Secretary a warning that we'll be raising this with him, I'm sure, in a couple of weeks. Mr Luke Murphy, MP.
Thank you, Chair. I wanted to ask about the route to growth for the sector. So do you see the route for growth as being consolidation or the establishment of new entities?
Would you like me to take that first?
Yeah.
So I think, access to capital, which is a regulatory issue, I certainly do think is part of the route to improving the resources available to the sector to grow. So those are definitely part of the answer. I can go into the detail of that now.
I guess I was asking more, but is that a barrier to new entities setting up, or growth and consolidation? Because the reason I ask is obviously no new building societies have been registered in the UK in a quarter of a century, and only 7 credit unions have been established in the last decade. So I'm just interested in the theory of growth of the sector.
Yes, yes.
Is it through growth of existing entities and consolidation, or do you think there's actually, are there barriers to establishing, and how do you see the sector growing? Which route, or is it a mixture of the two?
The answer must be as a combination. But the reason why I raised the point about regulation is because currently the regulatory arrangements are actually locking up capital. And I think the challenge is that really risk-based. And therefore, by unlocking that capital, then you can see some growth within the existing sector in terms of service to customers. This is what it's all about. In terms of structure, if I may pick up your point, and then perhaps we can return to regulation. I think consolidation may play a part, but it's not the only game in town. Obviously, we've seen in the building society sector acquisition, which of course is very positive, and the 2 examples there, the Nationwide and the Coventry. But there also may be scope for collaboration, short of consolidation. And Mr. Bland has already referenced the CUSO model, very well established in North America. I think there's about 1,000 CUSOs in North America. Mm-hmm. The opportunity for establishing...
we just sort of spell out CUSO.
Of course.
So we
I've already dived into the acronym soup.
9
Apologies.
weeks in
Yes, a credit union service organisation, a shared service model, yes? Mm. And obviously one that hopefully we'll see more progress on in the UK regulatory context. But really behind all that is the opportunity to collaborate and to share back office services. And that's particularly important where all building societies and credit unions, as Mr. Bland has referred to, have an extraordinary necessary challenge and are deep in technology transformation. And as we know, that's not a once and done thing. That's something that you have to really maintain a significant amount of capital to be able to invest in. And so perhaps collaboration may also be part of the mix of ways in which the sector can grow, both internally and also attracting new entry.
Thanks, Mr. Bland.
Yeah, so I think primarily we see the growth of the sector being consolidation and collaboration in the way that Ms. Harrison has described with the CUSO model. That's not to say there isn't a place for new entrants in the credit union space, but I think it's unlikely that we'll see the kind of pattern of formation that gave rise to the credit union model in the mid-20th century happen now. So small groups of colleagues or neighbours coming together to create an institution. We're in a regulatory vacuum initially, and then as legislation was brought in to provide a framework for that. In the context of the modern consumer expectations around digital services, for instance, the compliance expectations that a credit union now has to meet relative to a time when at the very beginning there was nothing. So it's not impossible to imagine that credit unions would come about as new entrants with some significant backing with a rapid growth plan, and we've seen a couple of examples of that, and we want to encourage more. There's one, in fact, we're supporting with a well-known figure in the personal finance space that I can't name, but is quite exciting, and that's in the pipeline now. So there's a space for that. But at the beginning of the century, the year 2000, in Great Britain, we had 700 credit unions. We now have fewer than 250. At the same time, the membership and the size of the financial balance sheet of those credit unions has grown exponentially. So that's growth through consolidation. I don't see any reason to think that trend is likely to change. It's the same pattern we see elsewhere in the world with credit unions in the Republic of Ireland and North America and so on. I think that is likely to be the pattern.
Would you not be concerned that kind of consolidation, if it continues, would take you further away from your customers? I mean, you talked earlier, I think, about the benefits of being drawn from local areas, and that being a big part of the ethos. Is that not a concern about that consolidation?
I think there is a balance to be struck always, and it's important that credit unions are connected to the communities they're serving, and there's a range of ways they can do that through their democratic structures and so on to ensure that they're meeting those needs. But fundamentally, as cooperative organisations owned by the members that use the service, it's ingrained in the DNA of the organisation that we're about our members and nothing else. And so, if you compare that with consolidation in a privately owned market, I think the two things aren't comparable. So I think we're much more likely to retain that connection to our communities because of that structure. That's not to say we should be complacent. Of course, there is a risk in that. But equally, we have to provide services in the way that modern consumers expect them. That takes investment, takes capital, and small community organisations struggle to keep pace with that.
I think Mr. Glenn.
Mr. John Glenn.
Great. Could I start with Ms. Harrison? I don't think we've had a new building society in the last 25 years. You referenced in late 24 the Nationwide acquiring Virgin Money, and then in January last year we had the Coventry acquiring the Cooperative Bank. And I recognise you also said that the consolidation allows to serve a wider range of customers. Can I just ask you, what point does a mutual become so different and to a normal high street bank that it is recognisably still a mutual? Because it seems to me that the direction of travel is that in order to achieve scale, to do some of the things that consumers are demanding, that pattern of consolidation will make the building society of the future unrecognisable to the one of a generation ago. Isn't that inevitable?
I don't think necessarily. So as I said, I reference consolidation as having a part, but also collaboration. There are other ways in which to create scale, to share and disperse costs, to make capital work harder, ultimately in service of customers, but obviously for the businesses to grow. So I don't think necessarily. I also think that, given that the Nationwide, these are very large organisations, but deeply invested in their communities. Some research that the Building Society Association did at the back end of last year, 85% of customers who are with societies would recommend that society, and 74% really see the connection and benefits that their society bring to those consumers, bring to those communities, I beg your pardon. So I think there is a real part to play, both at scale and also with the diversity that we have in the market. But I think given the cost base, there's a need to think about different approaches. Yeah. But I also think there is more that we can do on the regulatory side to release capital in the way that currently isn't available for that growth.
Only to Mr. Bland, you talked about the reduction in the number of credit unions, which I just recognise from my exposure to this a few years ago is reduced considerably. I think we've got 240 credit unions with less than 10 million in assets. Now, we talked about there's a sum of money mentioned of 13 million for transformation. Isn't there a danger that we'll get into a similar situation as we did with the credit union expansion project 5, 6, 7 years ago? That was, I think, 38 million, that generally was seen to have failed in terms of offering that sort of shared service to support credit unions. Why wouldn't we wait and to see further consolidation to a smaller number of entities before a serious attempt is made to provide a shared services to support those valued institutions?
Mr. Bland.
Well, I mean, you referenced the credit union expansion projects. Was about 10 years ago it finished, and I actually, in my time at ABCO back then, wrote a very detailed report, which I'm happy to send to you, about the reasons.
That is the precursor, isn't it, for the committee and for the wider benefit? I mean, that's what we're talking about, looking at again. Is that in essence?
Well, no, not quite.
Well, so, no, I mean, do it better, obviously, but
yeah, but it was. So if you'll allow me to. That was a kind of a centralised big bang approach to, build a platform in the middle and plug the credit unions in, and that will deliver the growth that we wanted. And there were reasons for that approach at the time, which you probably haven't time to go into now, but that isn't likely to be, and certainly won't be, the approach that we take this time. So we've learned the lessons of what went wrong with that example of investing in the sector. And instead what we expect to happen with Fair for All Finance, the entity that has the funding to invest, is a kind of a vibrant set of different investments that it's going to make into the sector, into different CUSO developments, for example, into new consolidation opportunities too, into new products and services for credit unions to deliver, and so on. And so whereas the project you referenced was very much a one big bang top-down approach. We're expecting a much more organic approach that comes from the sector, which is learning directly the lessons that we learned that I referenced in the report that we wrote back at the time.
Essentially what you're talking about is a series of interventions to set up a series of shared entities to support presumably different subsets of the credit union sector, which provide financial services alongside commercial organisations. Mm-hmm. What would be the justification for spending taxpayers' money to do so when, essentially you could go and get those services from another provider?
Well, first of all, it's money that's taken from dormant bank and building society accounts rather than taxpayer money, which is focused on financial inclusion. So Fair for All Finance is held to account as a quasi-governmental body to ensure that the money that it invests has that outcome for those that are excluded. And credit unions in that context are providing services to address a market need that the market isn't providing. And in fact, credit unions, mutuals and cooperatives have a proud tradition, in fact, through their cooperative structure and their mutual model of identifying market needs, and because of their ownership by members and by communities, creating new approaches. And that's exactly what the credit unions are doing here. And I think that's something that can be justified from a government point of view.
The direction of travel, and in very few months past in my 4.5 years as an economic secretary, did I not see a credit union fail. Then there was some consolidation. How would you reassure the public that investment in this space isn't going to be wasted and actually not be effective in improving the resilience of the credit unions you're supporting?
Well, as I say, we've learnt lessons from previous attempts to do similar transformation. This is likely to take, or will be taking, a very different approach. The failures you referenced generally are very small credit unions who are, voluntary organisations with very limited reach and impact in their communities. Small numbers of members, hundreds or maybe low thousands of members, all entirely protected by the Financial Services Compensation Scheme. And so whilst we do have some of that, that's typically the story. That's exactly why we want to see some consolidation to address some of these institutionally immature credit unions that may never reach that kind of critical mass to deliver services on a sustainable commercial basis.
Thank you. I'm not, just for the record, I'm not against credit unions, as I hope you recall. What I'm trying to do is draw out, how we can do this better.
No, I appreciate the question.
UN Young MP.
Thank you very much, Chair. And we're turning to reform of capital requirements. You've both talked about the need for this. And what specific changes would you like to see? I'll start with Ms. Harrison.
Thank you. I'll give a couple of examples, if I may. First of all, in relation to the FCA, at the moment there is an instrument known as, here's another acronym, CCDS, call capital deferred shares, which are available for issuance. Now, in actual fact, the FCA currently prohibits building societies to be able to issue that capital to retail customers. That's not the same as applies to shareholder banks or new challenger banks. They can go to their customers and use those instruments to raise capital. Now, of course, all of that would need to be done in an appropriately regulated way, but nonetheless, you have an immediate disparity there between the playing field upon which building societies operate relative to shareholder banks, and that's one example of an opportunity that could be reviewed. And I think the FCA indeed have signalled a desire to look at that, which is positive. The second, and actually at much greater scale, if I may, I think, is in the prudential space. And actually, it's always worth, we talk about the PRA and the FCA, but we shouldn't forget the Financial Policy Committee as well and the Bank of England. There are a number of regulators in this space. And at the moment, very simply, if I could describe it, in the UK we have a certain requirements in the prudential regulatory space to require capital to be retained as a ratio often of capital to assets for good prudential reasons. Those are normally, the levels are set sort of internationally, but in the UK we've added a UK requirement which is known as the leverage ratio buffer. Okay, and in practice what that means is that the obligation on some of our building society members is to hold a lot more capital than necessarily is reflective of their risk portfolio. And to give you an example to bring this to life, Nationwide have told me that in their case, if that UK leverage ratio buffer were not in place, they would be able to put available potentially an additional £30 billion of capital toward lending, either business or indeed mortgage lending. Another example, if I may, from the Coventry, which gave evidence actually to the House of Lords Economic Committee last year. That 980 years of credit losses is the requirement that they have to retain in order to meet their capital requirements. So there are opportunities here with the consultation from the Financial Policy Committee to see change.
So on that point about capital requirements, you're saying that the UK has requirements in excess of international comparators. In the Mutuals Landscape Report, the regulators write that many societies hold capital well in excess of their regulatory requirements, that is, their UK regulatory requirements. So given that fact, it seems that the level of capital that your members are holding is still well above even the UK requirements. So it seems that the ratio is not what is driving their desire to hold capital. Is there something else going on?
So the ratio is driving what's required. It's a regulatory requirement, and therefore there's an opportunity to look at that, and a serious opportunity, given the amount of investment potentially that could be put to customers' use. In terms of members' capital requirements, as I was describing earlier, there are big pulls on members for investment, significantly in technology, in order to make their services continually relevant to their customer base, and of course to maintain operational resilience. So these aren't insignificant requirements that do require capital ratios.
So what the FCA and the PRA are saying is that many societies hold capital well in excess of their regulatory requirements. So that the point they're making there is that it's not the regulatory requirements that are driving this excess accumulation of capital. There's something else going on in the sector. Do you think they have the right appraisal? Is that the appraisal that you would make of the sector?
So by virtue of the comments I've made, no. I think it is a combination. I think there is definitely requirements that members have, companies have, in terms of their and maintaining capital, but that's in service of their customers. But there are regulatory requirements that I think you've got to take this back to what is the risk here against which that capital is being held. These are so-called monoline businesses. They're businesses that lend mortgages, that provide savings products. They're not in high-risk credit markets, and therefore I think it's a real challenge for the regulator to think, or the FPC particularly, to think about have we got the right proportionate level of requirement, recognising the sector and the businesses and their purpose.
Thank you. Mr. Bland, I saw you shaking your head. Do you feel the regulators have got the wrong assessment when they say that they see many societies holding capital well in excess of their requirements?
Well, I can understand the logic of the point that's made in the report, which is, that we complain that the capital requirements are too high, but you're actually holding in excess of the requirement. Therefore, couldn't you put some of that to use? But the reality, sitting in a boardroom of a credit union or building society or another institution, is if you breach your capital requirement, you're in a regulator's line of sight as a firm that's failing to meet its basic requirements. Yeah. And so it's a natural inclination to put your own buffer on top of that to prevent the risk that you fall below the requirement, because of course these are dynamic, complex businesses, certainly in the case of some of Ms. Harrison's members, that they can't necessarily control fluctuations in capital moment to moment, so they give themselves some room for comfort, and so that there's a buffer. That's why that additional buffers it exists, because there are cyclical patterns through the year that take them close to the line. They need to take that into account.
Thank you. Luke Murphy, MP.
Thank you. I just wanted to follow up a quick point around the Law Commission that you mentioned earlier, and also access to finance. So obviously you mentioned the Law Commission was tasked by the previous government to look at the existing legislation for cooperatives. My understanding, or I've been told ahead of this session, that the work was supposed to also cover potential needed changes to increase access to finance for cooperatives, and that was meant to be done kind of alongside the Bank of England and regulators' work on the Mutual Landscapes report. And it had been suggested to me that maybe that working hadn't been making as much progress alongside each other as had been hoped. I just wanted to ask you whether that was your feeling as well, whether the Law Commission has been doing that work on the access to finance you think is necessary, and just whether you had any comment on that.
Well, I first of all need to make clear that the Law Commission reports don't affect building societies or credit unions directly, although cooperative society law does apply to credit unions to some extent. So I'm not as close to that as other people you might want to to seek that clarification from. But it's self-evidently the case that the Mutuals Landscape Report has reported and the Law Commission hasn't yet. So there does seem to be a misalignment of timelines. I couldn't comment on the reasons for that or anything further, really.
I haven't really got anything to add. I think the Law
Thank
Commission's
you.
work
Thank
is
you
very
very much.
focused
That's
on
fine.
the friendly and friendly sector.
Thank you very much, Mr Murphy. John Grady, MP.
Thank you very much, Dame Meg. So just in brief, the government's published its financial inclusion strategy. Mr Bland, first of all, what's your assessment of it in respect of credit unions and how credit unions can help with financial inclusion?
So first of all, it's very welcome. Is the headline. You know, we're very pleased to see, as I've said already, the commitment on common bond reform, the commitment to the investment in credit union transformation, and we do think the financial inclusion strategy is focused on the right areas, broadly speaking. But I do think there are areas where, you know, there are opportunities potentially to have gone a little further, or to maybe make the strategy somewhat more robust. A particular one that I'd like to mention is payroll savings. So there is a commitment to a coalition to support the expansion of payroll savings and savings in workplaces, something that many credit unions do with great success. Just last week we were talking we had an event here in Parliament with 3 of our members who are providing services to the armed forces under something called Joining Forces, something that's been now going for 10 years. They've reached 28,000 personnel and 15% of the active serving personnel, and have really made a significant impact, particularly through encouraging them to save. So the evidence that is a mechanism that works. However, the strategy relies on trying to promote this as a voluntary thing that employers ought to do. So to kind of give it a bit more profile, to encourage kind of voluntary commitments from employers to do this. But there's a growing body of evidence that shows that if we create an opt-out mechanism, a bit like we did with pensions, to allow for the automatic enrolment of employees in payroll savings, then we can have just as transformational an effect on the savings crisis we have in this country, with a quarter of working age households having less than £100 set aside in cash savings as we've had in pension saving. Now, we recognise expecting all employers to do that in the way that was done with pensions would be a big thing, but certainly a clarification of the legislative provisions around doing that for employers, should I say, that wish to, would have been a very positive contribution.
Thank you very much, Mr Bland. Ms Harrison, anything to add on the financial inclusion strategy?
Well, I think very welcome, and just on workplace savings, actually I'm very pleased that one of our own building societies, the Marsden Building Society, is trialling now workplace savings arrangements. So it's really good to see the building societies moving into this space. I think probably one of the most important aspects I would like to single out from the financial inclusion strategy was the commitment for financial education, particularly in the primary sector. Building societies have a long tradition of working with schools in their communities, building financial capability, and that is, I've got lots of examples I could share with you from Leeds to Yorkshire Building Society more widely to nationwide, and many others besides. I think that probably is one.
We'd say we have an inquiry into the financial inclusion strategy, so we may want urge you to write to us with it.
Delighted to do that.
Thank you.
And just something picking up really on what Mr Glenn was discussing with you about the use of fair for all finance money and so on. In my constituency, we've got a number of excellent credit unions in Glasgow more generally, and some of the stuff they do for outreach with things like food pantries and things may not necessarily carry a cost, running branches in poorer areas of Glasgow and so on. So financial inclusion carries a cost. Is it something that perhaps you could write to us about the incremental cost of helping people who really do need help on this front? Because one of the things that troubles me is actually if we're looking into the true cost of having a financially inclusive sector with things like branches and so on, in particular given that many organisations are closing their branches and becoming much more electronic, and that's something I suspect is an issue. Do you share my view, and if so, would you write to the committee about it?
I mean, broadly speaking, there are things that credit unions do and others that are a cost and need to be supported beyond the kind of core business, although our objective as a sector is to be able to, as far as possible, sustainably do that through our own trading income. I think one thing I would say about Scotland in particular that's worth noting is the investment that's been made with the Fair for All Finance money doesn't extend to Scotland or to Wales or Northern Ireland, because the dormant asset money that's being used is a devolved matter and hasn't been allocated to financial inclusion in those jurisdictions. So there is a question there, I think, for the Scottish Government and elsewhere to think, could something similar be done to support I know that's not the committee's remit, but that's something we're asking them to think about.
Well, there's lots of questions to ask of the Scottish Government, but I'll give up now.
We'll move from Scotland to the south east to Jim Dixon MP.
Thank you, Jane Meg. Just on the same theme, really, about how, as the financial inclusion strategy says, the community finance sector can serve underserved communities. In my area, I have an excellent credit union, Greenwich and Bexley, which, despite its name, does cover Dartford, which is my constituency. It's helped 17,000 residents since its formation. Currently, it only has 196 Dartford residents who are members or are receiving support from the credit union, and yet Dartford has 40% of its residents under some form of financial stress. So there's a big imbalance there of people who perhaps could benefit from the credit union services, and this very small number who are. Could you just tell me, just as an example, so the great work that Fair for All Finance are doing with the Credit Union Transformation Fund, how might, in practical terms, the application of that sort of investment enable that credit union to serve more residents who could benefit from their services, such as my constituents?
So I think it's likely to focus on three key areas. One is around structure and around some of the collaborative things we talked about. So enabling credit unions through collaboration with others to invest in better technology, to reach more of your constituents in a sort of remote part of their common bond, or to offer new products and services, to market themselves more effectively so that more of those in Dartford know what the Greenwich and Bexley Credit Union can do for them, and so on. So I'd expect that investment to focus on, the whole gamut of things that credit unions need to more effectively reach more people. More provision of services online. We know that many millions of people, annually are looking for credit online and receiving no affordable options. There's a £2 billion gap between the supply and availability of affordable credit that credit unions, if they doubled in size, could more than address. And then on the savings agenda, I think there's some more we could do through things like Help to Save, as I mentioned, if credit unions could provide it, or through the payroll savings initiative I already described, to help lower income households who need it to save, because with some of those mechanisms, the evidence shows that through something like auto enrolment, or strong incentive like is offered through Help to Save with a 50% match, even those on the lowest incomes can begin to save, and even small sums of money are transformational for the well-being of those individuals and those households.
Do you think there's enough, if I can put it this way, business acumen in the sector to make sure that a big investment like that, obviously it's a national investment, but these will be quite significant extra elements of investment for a credit union that may be relatively small? Is there enough business acumen to make sure? I mean, Mr. Glenn's been reminding us previous efforts haven't always gone as well as they should. Is there, can we have some sort of certainty, or certainly confidence that will work well?
Well, if I may say so, I know the chaps who run Greenwich and Bexley Credit Union well, and I'd say they have plenty of business acumen. But at the general level, the growth plan I mentioned we're publishing later today, leadership and skills and investing in the people that run the sector is absolutely a central part of what we need to do. We recognise that's an ongoing thing, but we've seen big strides forward over the last few decades in the professionalism of the sector and the standards of governance, and so whilst I can't say that it's fixed in every case and in every place, I think we're making good progress, and it's certainly a commitment we're making going into the future.
If I may, this is an area where perhaps Mr Bland and I can work in partnership. We have, as I described, some credit union members of the Building Society Association, and part of what we offer is training and capability building, both in regulation and in governance matters. There's an opportunity to bring some of that capability to bear in support of growing the expertise in our shared sectors across the board.
One final quick question. Was there anything in the financial inclusion strategy, was there anything not in the financial inclusion strategy you'd like to see in that we should be questioning the government around? Are there things that would have obviously supported the building society sector or the credit union sector that you still wish to see?
Well, I mean, I think when we last doubled the sector in the past in the credit union sector, there was a programme of investment under something called the Growth Fund, which was about £80 million in total. And whilst I'm not suggesting that we're not very grateful for the £30 million that's been allocated, I think there is a question about the scale of investment relative to the scale of challenge that there is in society, not just in credit unions but elsewhere. And I think that with a little bit more pressure, the banks may have been persuaded to do a bit more on both funding but also infrastructure and support for things like referrals. There are some promising pilots ongoing with credit unions, referrals of customers not eligible to borrow from a bank onto a credit union where they may be able to be helped with a kind of digital journey to link the two. And unfortunately, that didn't make it into the final strategy. I think that some of that could have been there with a bit more pressure on the bank.
I just ask on the strategy, which boards were your organisations on? Because there were different working groups, I think, weren't there, in developing the financial inclusion strategy?
The Building Societies Association, and indeed its members, were not unfortunately part of the working group or indeed the main committee. However, nonetheless, contributed.
You contributed from outside, you weren't involved?
Contributed from outside, and of course are very interested in and focused on delivery. And that may appear somewhat surprising given the...
There were no mutuals involved in the banking?
To my knowledge, there were no mutuals involved in the work. But in terms of the committee, but as I said, my organisation and our members contributed.
I'm not saying you had no voice, but you weren't in the room in making it. What about Mr Bland? What about the credit unions?
So we as a trade body weren't directly represented. The main committee, I couldn't comment with certainty whether there were no mutuals. There may have been some of the largest represented.
It would be helpful if you could check back. And
we can check, but certainly on the Affordable Credits Committee, which was most relevant to us, there were credit unions represented, there were mutuals represented, but that wasn't the main committee. And the trade bodies were contributing via members of ours to so it was an indirect input that we had.
It would be helpful if you could just send us the names of which organisations were there, because I mean, nationwide, we're having taken over Virgin Money and now dealing with business. I mean, there's a lot of things there that it might have had a useful input in, let alone the other building societies or trade body. Thank you very much indeed. John Grady's just got a quick
Mr Bland, just we've dipped in and out of the common bond throughout the discussion this afternoon. So could you summarise in very short form the top three changes, if you like to see to the common bond? And what you think the two key benefits are. So mindful we'll have this division bell soon. And
so the main one is really just the big one is the one I mentioned with Mr Glenn earlier, which was the common bond geographical limit being raised from 3 million to 10 million, and that's to facilitate more strategic consolidation where appropriate, but also expansion of credit unions' footprint. So a credit union like, for instance, the one that serves those working in Parliament, London Mutual Credit Union, which is a member of both of our organisations, and they serve only part of Greater London. And if you're living on the wrong side of the road in the wrong borough, you might not be able to access the services, and it is confusing for...
I understand that. Any other, is that the main one you want?
That's the main one, really. I think there are some other relatively small issues around family members, for instance. So there's an opportunity to have family members join a credit union if they live at the same address, but not if they live elsewhere, and we'd like that to change. But, relatively minor, the rest of the stuff we're looking for is, the main one is the ceiling.
Okay, thank you very much.
Bobby Dean MP.
Thank you, Chair. We received evidence when we were looking into ISAs, particularly from Skipton Building Society, about the potential damage that reforms could do to building societies. Obviously, the limit has been cut now, but there's this extra provision of people over 65 being able to maintain their savings in cash ISAs. Can you tell us where the Building Society Association is at now, having seen the outcome of the reforms?
Yes, of course. And look, it's no secret that the Building Society Association's members would prefer not to have seen that cash ISA cut. And indeed, perhaps, I know the Treasury Select Committee had a view about this as well, but that the route to encouraging more of an investment culture probably comes in large part through education, capability building and confidence making and so on and so forth. So that remains the case. However, in practice, we are now actually working through the detail of the implementation of the changes to the ISA regime. And it is good to say that because of the engagement from the Building Society Association, our members, and of course this committee and others, actually the proposals that have turned out have been less worse than they might otherwise have been. So that is a positive thing. But we can't take our eye off the ball because there is some very detailed implementation underway at the moment. And what we need to be very careful about is that in framing the arrangements as they will now apply, that we don't inadvertently permit the sort of £20,000 limit, tax-free limit, to be basically accumulated within a stocks and shares ISA, by the back door. And there is a risk of that, which is why we're working so closely with Treasury and HMRC to avoid that. That's not to say, as has been, I think, unfairly characterised, that it's not right within a stocks and shares ISA for there to be provision to be able to have access to cash or cash-like instruments, because, of course, people need to be able to de-risk. Yeah. But it shouldn't be a route to seek an alternative way of gaining the benefit of the £20,000 tax-free cash. And so we're watching that very closely. And if I may, I'd be very happy to keep the committee briefed on progress with that.
We're really very interested.
I'll come back to that latter point in a moment. Just to go back a step, you said as a result of the engagement, we were a little bit confused about why the number 65 is landed upon. It's not in line with the retirement age. Do you think that happened because that then allowed there to be more capital available to building societies? Is it a kind of direct result of your fears about being able to not able to lend as a result?
I think the combination of the limit reducing to £12,000 as opposed to £4,000, which was, I think, mooted at one point, and indeed the retention of the £20,000 for over 65s are a combination of the representations that have been made, and they are important, and they're important to building societies.
But Mr. Beam was specifically asking why they over 65. So did you have an influence on that?
Is that because you realised that you had a stock of accounts where people were over 65, and if they made it in line with retirement age, then that wouldn't have worked out as well? Was that part of your discussions?
So I would be very happy to follow up with the committee if that's helpful in answer to your question, to answer that directly. I don't have that detail to hand at this moment today.
You've only been there 9 weeks, to understand that.
As well as keeping the committee involved in the up to date on the implementation issues that I've raised.
And just moving on to the sort of cash-like assets held in stocks and shares and the plan to charge interest on it. I mean, what discussions have you had with the Treasury about this? And more broadly, it seems like the picture's getting a lot more complicated. Do you have any fears of customer take-up as a result of that?
Well, yes. I mean, that was always a risk with the changes to the regimes in the first place. And of course, in making the arguments that we're now making about how those changes are implemented, we have a mind very much that complexity. And of course, fundamentally, we don't want people not to take advantage of the opportunity for cash savings, and indeed, of course, cash ISAs, partly because, as you know, they're the route to lending of mortgages, but also partly because it's part of the story of how we build a more resilient, more financial resilience among our customers and our citizens. And it's worth bearing in mind that I think something like, back from our analysis, although overall savings have increased, nonetheless, as an aggregate level, our research shows that we still have 12% of adults who have no savings at all and would not have the ability to be able to reach for emergency funds. So creating the right savings culture, not overcomplicating, remains something that we will work with Treasury and HMRC on as we seek to implement the changes that have been made.
I think we're going to come back to savings later on, but for now...
But this cash-like thing is puzzling, I think, puzzling a lot of us. You've got no clarity on what that means at the moment, just to be really clear about what you said.
So I think so there are at the moment you can retain within a stocks and shares ISA both cash and cash-like instruments for de-risking.
Yes.
The issue is at what quantum,
yes.
and our concern, understandably, is to avoid our members' concern is to avoid that becoming your ability to be able to place new money into the cash mechanisms or cash-like mechanisms within the stocks and shares wrapper, taking advantage of the tax arrangements, which is a big loophole, given that we've had a change in the arrangements affecting cash ISAs. So that's what we're focused on.
From your point of view, if people could move from their stocks and shares ISA somewhere at the point of de-risking and put that into a cash ISA, would that be something that the Building Society Association and your members would do?
Yes, if that were possible, to be able to have more portability, if you like, across.
Is that something you've been saying to government?
So we've been talking to government about the implementation of the regime, and we have, that's something we've referenced, but that's not something that's currently on the table, hence our focus on making sure that the way that the arrangements are applied don't disadvantage the cash regime.
A couple of questions then. How long do your members need to get this right? Because we are in the end of January. You don't have clarity yet. This has got to be implemented by 2027, and your members have got to let customers, like your average retail customer, understand what this might mean. When do you need clarity by?
Well, this is really pressing, and we are working. And by the way, I think, to be fair, both Treasury and HMRC know this and are working very fast, and there are regular engagement, including with myself and at the BSA and our members.
Do you have any idea when you'll know?
So at the moment, I think I couldn't say exactly when it's due to be concluded, but I know, not in the too distant future for obvious reasons, because although there's an issue, of course, about notifying customers rightly, so we don't avoid the complexity and see that sort of chilling of the market, for want of a better phrase, there are also quite significant implementation costs.
Well, that's my point.
So yes,
yeah.
so we're
How long
pressing
does it
for
take
resolution.
to change? How long would it take? Have you got an idea of time?
So I can again provide that briefing, if I may, and an update on where we are.
When's the deadline you have to know by? And would you consider gilts to be a cash-like investment?
That again is something I'm very happy to deal with in a fuller response, if that's helpful.
But just building on that, I mean, there are quite a lot of cash-like instruments, money market funds, different sorts of gilts and so on. This uncertainty is surely a big concern for your members, and wouldn't you have expected this to have been resolved before the announcement was made?
Well, that would, of course, in an ideal world, that would be the case. But I think what's more important is the level of engagement that we've got. I think it's a very open door from HMRC and Treasury, and working closely to make sure we get this right. And, from my point of view, this is critical to our members. And our members are very clear on the need for us to continue to press for this. And I'm very pleased to keep the committee involved.
Very soon then.
Yes, absolutely. Absolutely.
Thank you, very helpful. Well, helpful as far as it goes. I think we all need more information, but I think helpful to know we need more information. And Dame Harriet Baldwin.
Thanks, Chair. Ms Harrison, I always think of building societies as being primarily focused on ensuring that there's a lot of choice for consumers in the mortgage market, and that you play a very big role in the mortgage market. And obviously steps have been taken to expand mortgage lending. The FCA and the FPC have eased rules to some extent. So can you just explain how your members are reacting to that? Are you comfortable with the changes? Are your members using them? Are there any other further changes you want to see?
Yes, thank you. Let me deal with the FPC point first, if I may, because as you reference, there were changes to the so-called LTI flow limit last summer. And the result of that actually is very positive. I think about 4 of our Building Society members sought the exemption as a result of those changes. And as a result, we saw, I think, between 17,500 and 20,000 additional mortgages lent to first-time buyers. So our work now is focused with the FPC on what will be the successor to those current arrangements, because they expire in the summer of this year. So we hope very much, and we believe that there will be a case for continuing with that flexibility. On the FCA side, again, a real, positive opportunity, which the BSA and our members have been arguing for probably since 2024, to see much more flexibility in the approach to the mortgage regulatory regime. And we are seeing now an agenda of reform. That work's going to continue this year with the FCA. And I think the thing for us that's most important is to try and seize the opportunity, not to tinker, but to really look for substantial flexibility in the approach, because Building Society members have a very long reputation of delivering really products that meet customers where they're at, rather than providing sort of template type products. And we have, as we know, lots of different customer needs even in the first-time buyer market. We tend to think of that as being younger people starting out, but actually it sometimes can be because your life circumstances change, yes, and therefore you want to be able to access what might be favourable terms. And what you'll see across the building society sector are, in terms of deposits, you'll see either no or zero or very low deposits linked, for example, to rental income. You will also see products and services that are evolved to recognise the particular circumstances of those who find it difficult to get access to mortgages, perhaps because they don't have regular income or they might be self-employed and so on and so forth. So I think with the FCA, our expectation, our hope is that we'll see that kind of flexibility to be built into the regulation as it evolves. And again, I'm very happy to keep the committee informed of our experience.
So you welcome the changes so far, but you've actually still got a clear agenda for further changes.
We do.
And are there still European directives that are affecting your members?
I recognise you've been in the job 9 weeks. That
might be one for me to come back to you on, if I may.
Okay.
Thank you.
Right. No, that's absolutely fair enough. And in terms of a policy that was announced by Nigel Farage at Davos, he was saying that he would, if he were Prime Minister, cause the Bank of England to stop paying banks and presumably building societies on their reserves held with the banks. And I wondered whether the Building Society Association had a view on what that would do to your customers.
To my knowledge, we don't, but I would be very happy to take that away. And if there's anything further to contribute, I would be pleased to do so.
Thank you, Dame Harriet. And Catherine West MP, but before you speak, I think you just might need to declare your interest.
I am a member of the London and City Credit Union and was a member of the Cooperative Party, formerly a Labour cooperative councillor, and also bank with a Nationwide. And I wanted to ask about mortgages in terms of the extra backroom resource that mutuals might need. For example, there are a lot of checks that go into doing mortgages, and we have the earlier evidence that was given in the committee. What extra resource might the sector need in terms of that very extensive checking that goes on around, say, mortgages because there's certain sorts of mortgages which, say, the Nationwide can lend, but others which they don't, in order to upscale? What would be the sort of extra resource that might be needed?
So I think perhaps a couple of comments on that. First of all, a number of members of the Building Society Association will do manual kind of mortgage lending processes. So obviously, in order to scale, the role of technology will be very critical there, and of course the application of AI has a potential role to play. That requires the investment, that requires the capital, that requires some of the things we were talking about earlier in the committee. They need to be able to retain that, to be able to invest, or indeed to share those resources across building society members. I think that's probably the most I'm able to sort of reference right now, but again, very happy to come back to you with further information, but Mr. Lamb may want to add.
So there are a small number of credit unions that offer mortgages too. And I think there is a challenge for smaller institutions in terms of maintaining the resource that you describe, which is one of the areas we think there's potential for a kind of CUSO development. So the credit union service organisation structure, pooled investment between credit unions in order to build the infrastructure you might require to deliver an efficient and effective mortgage underwriting approach, which could be delivered for multiple credit unions, and that could unlock an opportunity for more credit unions to do that, because it's a very significant undertaking for a credit union on its own. And there are analogues of that in other markets like credit cards or car finance or other areas where there's potential for credit unions to play a role, but many are likely to need to share the investment amongst a group of credit unions through a CUSO approach.
Thank you very much, Ms West. And finally, Bobby Dean MP.
Thank you, Chair. So we'll come back to savings. We've been speaking to the Bank of England about this sort of elevated level of aggregate savings, and I just wondered, and you know, all sorts of theories about why that might be, the succession of shocks to the economy and so on. I just wondered if you could tell us about any trends that you spotted amongst your members, and if there's any differences between different groups of people.
Who's that to first?
To Ms Harrison first, please.
Yes, I mean, look, I can make some general remarks here, but again, you know, to the extent it's helpful, I'm sure we can offer some further information to the committee. I mean, I suppose you're right. At an aggregate level, you know, households in our observation have been saving more. And in the cash ISA space, we obviously saw quite a significant uptick of investment in cash ISAs during the course of last year to the tune of about 20 billion pounds, beg your pardon, not 20 billion, 20 billion pounds between April and around the end of the year. And that may be because of an uncertain economic environment, yes. People not feeling confident in spending, and therefore those savings accumulating. I emphasise the aggregate nature of that, and of course, as I've already referenced, you know, that hides all sorts of things that are really challenging, because particularly in our research, 12% of adults are simply not saving at all and not able to, and that really is should be a concern for us all. It certainly is for my members. So therefore, we need to think carefully about what we can do to make that more easier. And as you may know, the Building Society Association sponsors, and has done for a number of years now, UK Savings Week. It's the 21st to the 27th of September. I would be keen for members to give it its support. And credit unions, and indeed actual banks as well as shareholder banks too, because it's a way of really raising the profile of the different routes that can be taken to build some financial resilience.
Thank you. And Mr. Blunt, any comments you might want to add, but also if you could give us some insight to the other side of the coin about borrowing, and whether or not you've seen any trends in defaults or arrears as well.
Yeah, so I mean, there's been a slight uptick in arrears over the last sort of year or so with credit union lending. You know, as we've said, it's a mixed picture. That not all credit unions are the same, serving the same markets. But broadly speaking, we have a focus on you know, those at the lower end of the income spectrum, and for reasons that we obvious in terms of the ongoing pressure on households through inflation. You know, those at the lower end of the income spectrum have been struggling. It's not quite as pronounced as it was, you know, a few years back when we had the peak of inflation, when things, you know, were really challenging for lots of people, and that, you know, for many credit unions that just meant that they weren't able to lend when they may have otherwise done prior to the inflation, because it ate into people's income in a way that their affordability just wasn't there to borrow.
And about defaults, have you seen any change in that trend? I mean, are people defaulting on their debt more often than used to?
As I say, there's been a slight uptick in the aggregate statistics across the credit unions, but nothing, you know, too concerning. But I think the rate of growth in lending is perhaps lower than it might have been, because I think it's, you know, credit unions are tending to manage that through not lending, you know, and because of a concern at affordability. And of course, like all lenders, we're subject to requirements in terms of proving that a borrower can afford to repay a loan, and as ethical lenders, you know, that's particularly important for our members. I think there are opportunities within that, though, in the context of financial inclusion strategy. You know, Fair for All Finance, again, has explored and has piloted the no-interest loan scheme, for instance, and I think there's an opportunity. I think I've always been a sceptic about whether the interest is the element that makes the difference there, but, you know, in terms of whether someone can repay or not, the principal sum repaying that is the challenge in the most part. But what that scheme, it's an additional
Glenn
payment.
had an involvement in this when he was in government.
I know he was the sponsor of NILS,
yeah.
but the you know, additional payment at the end of a term, either you can afford the payments or not. You know, ultimately, it's not the interest that makes the difference. What's been interesting about the NILS experience is the fact that
a bit a few years ago.
Sorry.
We'll
be temperate, but we get this man finished, and I'll bring in Mr. Glenn in.
We could have to agree to disagree on my previous views on NILS. But what's been really interesting, as I was saying, was that the underwriting that's been provided to the lenders, credit unions amongst them, to say there are people here who want credit, but their credit history is quite challenged. They maybe have affordability, or their affordability is just about there, but they've had problems repaying credit in the past. And being able to support them to take a chance on someone who wants to turn that around has demonstrated real results in terms of credit unions and other lenders like us being able to explore where that risk appetite ought to be. And that's been the powerful learning from the Nils experience, I would suggest. And if there are opportunities to expand that approach elsewhere.
We've looked at AI in financial services. We've seen some interesting things about profiling, particularly around insurance. Is this, I mean, are many of your members, I guess not so much in the credit union world because it's quite small, is AI being used? Is that a danger to you? Is that good because it's personalising, or is it bad because it's taking over from that personal touch that you just described, Mr. Bland? Start with Mr. Bland. Very brief question, but just briefly.
I think to a limited degree AI is being used by credit unions. It varies between...
And is it making a difference to lending decisions?
I think it has the potential to significantly enhance the efficiency of making decisions. You know, summarising information, enabling an underwriter to make a decision. Not for making decisions generally, but speeding up the processing that goes into making a decision.
Ms. Harrison? Anything?
Yes, I mean, I think largely probably in service of more productivity and improving the experience for customers. It's not there's not evidence at the moment of its application in the way that you describe. I think the other thing I would just mention, though, when they're looking at the consumers' end of things, the work that's been led by Land Registry, by the Ministry for Housing and Local Government, think about simplifying the mortgage process, and there will be perhaps opportunity for the application of AI. There's a real benefit there. It takes too long to be able to go through the mortgage application process. There's real opportunity to simplify with AI.
Okay, thank you. I think we're expecting a vote in a moment. So just one thing that would be helpful if you could write was about the geographical spread of your organisations. And Ms. Harrison, you said there was none headquartered in London. Mr. Bland, you said you've got a high concentration in Northern Ireland, but it would be helpful to have a spread of how many are in the south and southeast. It's interesting to see that you have a lower London presence than a lot of the banks. To put it mildly. Can I thank our witnesses very much indeed. That's Sarah Harrison, Chief Executive of the Building Society Association, and Matt Bland, Chief Executive of the Association of British Credit Unions Limited. The session's been helpfully recorded by Hansard, so thank you to our colleagues there, and their transcript will be on the website uncorrected in the next couple of days. Thank you too to our colleagues at Bowtie. Thank you very much indeed. Order.